Welcome to AI World TV, your go-to destination for everything artificial intelligence. Discover the captivating landscape of AI, where advanced technology finds real-life application. Subscribe to AI World TV for webzine articles, reports, podcasts, videos, live events, and latest trends. Hear from top industry leaders and discover how AI is transforming industries and our daily lives.
For the last 20 years or so, we've basically been sold this idea that technology is the ultimate equalizer.
Right. Oh, absolutely. The classic democratization of wealth story.
Exactly. Like a couple of smart kids in a garage write some code, the whole world downloads it, and suddenly they're ringing the bell at the stock exchange.
Yeah, it's a great narrative. I mean, it defined the entire internet age.
It really did. But I want you to ask yourself a question today. What happens when the biggest, the most transformational technological revolution of our time completely locks out the average investor?
Well, I mean, it is a profound shift. We're essentially watching the doors close on the very mechanisms of capital formation that built the tech sector as we know it.
Yeah, and it's happening quietly, like right in plain sight.
Which is pretty wild when you think about the scale of it.
Right, which is exactly what we are getting into in today's deep dive. We are pulling from this really fascinating piece published in the AI World Journal.
Yeah, from June 4th, 2026.
Yep, by Sydney Armani. It's titled AI IPO Market Isolation: How Artificial Intelligence is Reshaping Capital Formation.
And it's such a crucial analysis, because it looks past all those flashy headlines about what artificial intelligence can actually do.
Right, the chatbots and the image generators.
Exactly. And instead it focuses on the underlying plumbing, like how it is being paid for, who holds the purse strings, and why the established rules of corporate finance are being fundamentally rewritten.
Okay, let's unpack this. Our mission today is to figure out who is really going to capture the immense value being generated in the AI economy.
And to do that, we really have to start by tearing down a massive myth.
The idea that AI is just, quote unquote, the next software.
Right, because we are so used to the software as a service model, right? The SaaS model.
Oh, totally. Where you write the code once and then distributing it to user number 1 million costs basically nothing. It's essentially free to scale.
And that zero incremental cost model, I mean, that created the highest margin companies in history. But AI introduces a completely different economic reality.
A very physical reality.
Exactly. One that is deeply, stubbornly tied to the physical world. The analysis focuses heavily on this concept of infrastructure physics.
I love that phrase, infrastructure physics, because it completely shatters the illusion of the cloud.
It really does. The cloud isn't just vapor, it's metal and electricity.
Right. To build advanced AI systems, you can't just hire a bunch of brilliant programmers and buy them some laptops. You are looking at staggering investments in physical computing infrastructure, specialized memory technologies, and literally gigawatts of power.
What's fascinating here is that the physical supply chain becomes the ultimate bottleneck. We're talking about the need for cutting-edge photolithography machines just to print the chips.
And those aren't exactly easy to come by.
Not at all. And then we are dealing with highly specialized advanced packaging, specifically things like TSMC's CoWoS. And of course, there is this insatiable demand for highly volatile, high bandwidth memory, or HBM.
Wait, let's pause on that. TSMC's CoWoS and HBM?
Yeah, it's a lot of acronyms.
It is. If I'm an investor used to standard sauce companies, those just sound like alphabet soup. What are these technologies actually doing, and why are they suddenly the center of the universe?
Fair point. So let's break down CoWoS first. It stands for chip on wafer on substrate.
Okay.
Historically, we made computer chips by placing components next to each other on a flat board. Think of it like a sprawling one-story suburban neighborhood.
Everything spread out.
Right. But as AI models get massively complex, the data has to travel too far across that suburb, which takes time and, more importantly, energy.
So it's inefficient.
Highly inefficient for AI. So CoWoS is a specialized manufacturing technique that stacks the chips. Yeah. You're essentially building a 3D high-rise skyscraper for computer components.
Oh, wow. So you pack them tighter so the data travels vastly faster.
Exactly. It's a completely different way of manufacturing the physical brain of the computer.
And I'm guessing that's not cheap.
Not at all.
Wow.
It requires incredibly specialized, multi-billion-dollar fabrication plants to do it. And then, you have HBM, or high bandwidth memory.
Right, the second acronym.
Yeah. If the processor is the brain doing the math, the memory is the filing cabinet holding the data.
Makes sense.
In AI training, You are moving mountains of data back and forth constantly. Standard memory connections are like a one-lane country road.
Which would cause a massive traffic jam.
Exactly. High bandwidth memory is a 50-lane superhighway stacked vertically right next to the processor.
Man, it's like we spent the last 20 years building apps in our dorm rooms, and suddenly, to build the next big app, you need to construct a literal steel mill first.
That's a perfect analogy.
You can't just code your way out of needing factory floor space and specialized construction equipment.
Which completely redefines what constitutes a competitive advantage. I mean, technology leadership is no longer just about having the smartest engineers or the most elegant algorithms.
Right, because what good is the algorithm if you don't have the hardware?
Exactly. It is now interconnected with heavy industrial capacity. You have to secure long-term energy contracts for the data centers. You have to navigate complex geopolitical trade restrictions just to get the photolithography machines.
Those are those massive devices that use lasers to print the microscopic circuits, right?
Yeah, highly restricted, incredibly complex machines.
Because if you and I are competing to build the next frontier AI model, and my model is technically smarter, it simply doesn't matter if you manage to secure the power grid and the factory floor space, and I didn't.
Nope. You can't outrun a competitor if you literally cannot turn your machines on.
That is wild. The AI economy is starting to look much more like the heavy industrial expansion cycles of the 19th and 20th centuries than the software booms of the 2000s.
It's all about building capacity and securing constrained supply chains.
So, if building this digital steel mill requires billions in physical tech, standard startups are going to go bankrupt before they even write their first line of code.
Without a doubt.
So if you are a frontier AI builder today, how on earth are you paying for this?
Well, the market has fractured into two distinct but highly dependent groups to solve this exact problem.
Okay.
You have the infrastructure providers, the companies making the chips, running the cloud data centers, building the power networks. They are the direct beneficiaries of all this spending.
So the ones selling the pickaxes in the gold rush.
Exactly. And on the other side, you have the frontier AI builders and the model developers.
The ones actually training the systems.
Right. They are doing the heavy research, training these massive systems with the hope of becoming the platforms of the future. But they need billions in capital to buy those pickaxes.
And I imagine they don't just want to go to a bank and ask for a $10 billion loan.
No, and they desperately want to avoid diluting their equity by selling off shares at low valuations just to buy servers.
Which introduces one of the most fascinating financial shifts in recent history, this whole concept of compute as currency.
It is a remarkable innovation in how deals are structured, really unprecedented.
Yeah, because instead of handing over cash, the massive hyperscalers, so think your Microsofts, Googles, and Amazons, they are providing the actual compute capacity.
Right. They are giving these startup builders the server time they desperately need.
And in exchange,
they are taking equity, securing revenue shares, or locking in favorable pricing agreements.
Hold on. If Google or Microsoft is trading server time for equity, aren't they basically running an unregulated venture capital firm out of their IT departments?
Pretty much.
How does that even work on a balance sheet? Are they basically reverting to a barter system?
If we connect this to the bigger picture, it is a massive gray area that financial regulators are genuinely struggling to catch up with. The hyperscalers are effectively acting as venture capitalists.
But without the traditional VC funds.
Right. Instead of using traditional investment funds filled with client money, they are using their own massive balance sheets and their physical infrastructure to buy a seat at the AI table.
They recognize their server capacity as an asset, and they swap it for ownership.
Exactly. And it locks the builder into their cloud ecosystem, sometimes exclusively.
Wow. So if the only way to afford the compute is to partner with one of the 3 or 4 biggest tech companies on Earth, that keeps all the power heavily concentrated.
Very concentrated.
The incumbents basically get to play kingmaker. They decide which startups survive based on who gets access to this superhighway.
It creates a closed ecosystem. The capital and the resources just cycle between a very small, very powerful group of global players.
Which has massive implications for how these companies eventually interface with the public market.
Huge implications.
And this is where it really impacts you, the lister. Because historically, when a tech company reached a certain size and needed a massive infusion of growth capital, they went public.
Right. They filed an IPO.
Yeah, and retail investors, mutual funds, your pension plan, everyone got a chance to buy in.
But this symbiotic loop we're talking about is breaking that tradition. It's leading to what Armani terms IPO, market isolation.
Because these frontier AI companies are getting so much backing from the hyperscalers.
Yes, from hyperscalers and strategic corporate partnerships. They are accessing capital at a scale that used to only be possible through a public offering.
So they just don't need the public markets anymore.
Not at all.
It's like an exclusive VIP club where the bouncer doesn't just stop retail investors from getting in line, he doesn't even let them look through the window.
That's a great way to put it. The public market is effectively locked out of the foundational layer of the AI revolution.
But let's dig into the mechanics of that for a second. Because the main reason people push for an IPO isn't just to raise money for the company's bank account.
Right, it's for liquidity.
Exactly. So the early employees who have been working 80-hour weeks and the early venture capitalists can finally cash out and buy a house. If Google is paying these startups in compute power, nobody's getting actual cash.
Right.
How do employees buy houses with server time?
That is the perfect question. And it brings us to the rise of what are being called shadow IPOs.
Shadow IPOs. That sounds like something out of a financial thriller.
I know, it's a very dramatic term, but it basically just refers to secondary tender offers facilitated entirely within private markets.
Okay, so how do the mechanics of that actually work?
Well, when an early employee or an angel investor wants to cash out, the company organizes an internal liquidity event. They allow those individuals to sell their shares to large institutional buyers.
But who is providing the cash for these tender offers if the hyperscalers are just giving them compute? Where are the actual billions of dollars coming from?
Sovereign wealth funds, mega private equity firms, and massive family offices. These entities have billions in cash just sitting around, and they're desperate for exposure to the AI boom. So instead of waiting for a public IPO,
You are listening to the AI World Podcast, your trusted source for the latest innovations, insights, and trends in artificial intelligence, blockchain, fintech, and decentralized technologies. Each episode features expert interviews, engaging discussions, and in-depth analysis of how AI transforms industries worldwide. Stay ahead of the curve with the latest articles and exclusive reports from the AI World Journal, covering everything from emerging technologies to industry breakthroughs. For more news, global events, and access to AI World Society circle gatherings, visit us at aiworld.tv. Don't forget to subscribe to stay informed, stay connected, and be part of the AI revolution with AI World Lounge. Thank you for listening.
IPO, they approach the private AI companies and offer to buy the shares directly from the employees at multi-billion-dollar valuations.
All without ever filing an S1 with the SEC.
Exactly.
Without ever opening their books to the public scrutiny, the media cycles, or the retail investors of a traditional IPO.
The primary historical reason for going public providing liquidity to stakeholders has been completely neutralized. The private markets have become so incredibly deep and so well-funded that they can handle these massive liquidity events internally.
Wow. So if you were sitting at home wondering why your standard retirement portfolio might not be directly capturing the explosive growth of the foundational AI boom the way it did during the early internet days, well, this is why.
Yes, the foundational layer is isolated.
You can only get exposure indirectly, right? Like by buying stock in the big infrastructure companies that are providing the compute.
Precisely. And, that isolation isn't just because these AI companies can stay private. Economically speaking, they kind of have to stay private.
Which raises an interesting point. Here's where it gets really interesting. Even if these frontier AI companies woke up tomorrow and decided they wanted to ring the bell at the stock exchange, would the public markets actually want them?
It sounds counterintuitive, given the massive hype around AI, right?
Yeah, you'd think Wall Street would be drooling over them.
But there's a deep structural friction between the underlying economics of advanced artificial intelligence and the rigid expectations of Wall Street.
Let's go back to that software myth we talked about earlier. Public markets love traditional SaaS.
They absolutely love it.
They love it because it's predictable. You have a subscription, and the gross margins are often, 80% or higher? Because the cost of delivering the software is basically zero?
Exactly. Wall Street analysts have spent 2 decades being trained to reward that kind of rapid operating leverage.
But advanced AI is a fundamentally different beast.
We really need to distinguish between the cost of training a model and the cost of inference.
Okay, let's break that down. Training is the massive upfront capital expenditure, right?
Right. Buying the chips, building the data center, running it for months to teach the AI.
And inference is the ongoing operating cost.
Exactly. It's what happens every single time a user asks the AI a question or asks it to generate an image.
And unlike standard software where loading a web page costs a microscopic fraction of a cent, AI inference carries very meaningful, highly variable operating costs.
Every single query requires the processors to crunch massive amounts of data in real time. It requires raw compute power for every interaction.
Wait, so basically you're telling me every time I ask a chatbot to write a grocery list, that's costing them actual money?
Yes. Fractions of a cent, sure, but when you scale that up to millions or billions of queries a day, those fractions turn into millions of dollars in variable costs. The cost of goods sold, or cost chasse, for an AI company scales linearly or sometimes even superlinearly with its usage.
Superlinear scaling. So you're saying that for a foundational AI model becoming wildly popular and suddenly getting 10 million new daily users could actually ruin their profit margins in the short term.
Yes, because they require massive, continuous capital expenditure just to service the user base, let alone train the next smarter generation of the model to stay ahead of the competition.
Which completely destroys the traditional, predictable 80+% gross margin model that public markets expect from technology stocks.
No wonder they don't want to subject themselves to the quarterly earnings cycle.
I mean, if you go to Wall Street every 3 months and say, great news, we grew our user base by 500%, but our profit margins completely collapsed because we had to buy more compute to answer their questions, Wall Street will absolutely crush your stock price.
They would. Public markets ruthlessly prioritize efficiency and short-term financial visibility.
Yeah.
They would aggressively punish a frontier model builder for prioritizing necessary long-term capital investment over immediate margin expansion.
It's a total mismatch. The traditional valuation frameworks that analysts use to price technology stocks are basically useless for these frontier model builders.
Completely useless.
The way they burn through capital to build the future just doesn't fit into a tidy quarterly spreadsheet.
The builders need patience, enormous capital, and the freedom to operate with terrible margins for years just to establish market positioning. The public markets want predictable, expanding margins right now.
Wow. Okay, let me summarize where we are. Foundational AI is heavily reliant on constrained physical infrastructure, like CoWoS packaging and high bandwidth memory.
Yes.
It's locked up in a symbiotic loop with a few massive hyperscalers trading compute for equity.
Check.
It's isolated in private markets through shadow IPOs funded by sovereign wealth.
Yep.
And its fundamental unit economics are a margin-crushing nightmare that public markets would hate anyway.
That paints a very accurate picture of the foundational layer today.
So what does this all mean? I mean, if foundational AI is this capital-intensive, margin-poor oligopoly locked behind closed doors, where is the actual investable opportunity? Where does the value actually go?
This raises an important question, and we really have to look at market history to answer that. Heavy infrastructure waves always favor a tiny oligopoly in the beginning because of the sheer scale of investment required.
Right.
But that is rarely where the ultimate long-term equity value settles.
Think about the telecom companies during the internet boom. They spend billions upon billions laying down the actual fiber optic cables, digging up roads, and building out the data centers.
They physically built the internet.
Exactly. It was a period of massive, unforgiving capital expenditure.
But the telecom companies aren't the ones who became the trillion-dollar titans.
No. The ultimate value creation migrated to the platforms built on top of those expensive cables. Search engines, social media platforms, digital commerce. They didn't lay the cables, they just used them to change how we live.
And the analysis suggests AI is going to follow a very similar bifurcated pattern. Eventually, these massive foundational models will become incredibly powerful, but also heavily commoditized.
They become utilities, like the electric grid or the municipal water supply.
Precisely. And when something becomes a regulated utility, its margins compress even further. I mean, you don't see massive equity multiples on the company that provides your tap water.
Right.
If the foundational models are just laying the pipes and pumping the raw intelligence, the true equity value shifts to the application layer.
The application layer. This is where the actionable insight is for the listener. The future of value creation will emerge through highly specialized businesses built on top of these foundational systems.
Yes.
Let's run through the specific fields where this is likely to happen, starting with healthcare and drug discovery.
So in drug discovery, you take the raw reasoning power of a foundational model, the utility water, so to speak, and apply it to the hyper-specific, highly regulated world of molecular biology. The AI can simulate millions of protein folds in hours, which fundamentally shrinks the timeline for bringing a new pharmaceutical to market.
That's huge. Then there's legal tech, focusing on contract generation and case law analysis, and finance, specifically what they call alpha generation.
Right. Alpha generation is the holy grail in finance. It basically means finding those tiny, hidden advantages or anomalies in the market that generate returns above the standard benchmark.
So beating the market.
Exactly.
Huh.
AI models that can ingest and synthesize global news, satellite imagery, and supply chain data in real time can identify those advantages before human traders even finish their morning coffee.
And then there's enterprise productivity, utilizing what are called agentic workflows. I want to be clear on what that means because it's a big leap. An AI chatbot answers a question, right? But an AI agent actually executes a multi-step task.
That's the key distinction. In an agentic workflow, you aren't just asking the AI to draft an email. You are giving it a goal.
Like,
You say, analyze our Q3 sales data, identify the 3 worst performing regions, draft performance review emails for the managers of those regions, and schedule meetings on my calendar for next week.
oh, wow.
Yeah. The AI autonomously figures out the steps required to achieve the goal and executes them across different software platforms.
And what makes these application layer businesses so compelling is that their economics look entirely different from the foundational builders.
Right, completely.
They require significantly less capital to get off the ground because they aren't training the multi-billion-dollar models from scratch. They are just using them via APIs.
They are paying the utility bill to access the raw intelligence and then using it to build highly scalable, specialized software. As a result, they have much better unit economics.
They don't have the super linear Code.js problem.
Exactly.
Which means they perfectly fit the traditional public market profile we discussed earlier. High margins, predictable revenue, scalable software. This is exactly what Wall Street understands, values, and rewards.
The conclusion here is that these application companies, the ones solving highly specific domain-level problems, are far more likely to become the next generation of IPO market leaders.
That is a vital pivot in how to think about this space. Everyone is staring at the giants, wondering how to invest directly in the next multi-trillion parameter foundational model, but the writing is on the wall. Don't look there.
Right. Look at who is building the cleverest machinery that hooks up to the giant's utility grid.
It is a profound shift in capital formation. AI is actively rewriting the rules of corporate finance by decoupling the most groundbreaking core innovations from the traditional public markets. The primary bottleneck for the core technology has shifted from human talent to physical compute and energy.
It changes how markets operate, who holds the power of capital deployment, and ultimately who gets access to the opportunities created by this technology.
And knowing this gives you an incredible advantage. You aren't just reading the headlines about the latest AI benchmark tests. You understand the hidden financial architecture underneath it.
You know where the capital is flowing, why it's trapped in private markets, and exactly where the actual investable opportunities are going to emerge in your own industry. You can look past the infrastructure noise and focus on the practical application of the technology.
Which brings us to our final thought for today. We've talked a lot about this idea of foundational AI becoming a utility, a massive commoditized pipeline of raw intelligence.
Yeah.
I want you to really picture that infrastructure. If foundational intelligence truly devolves into a cheap, regulated utility, exactly like the water flowing through municipal pipes, well, then the most valuable commodity in the future won't be raw computing power at all.
Not at all.
It will be the highly specialized human knowledge and the proprietary data you hold that feeds into those pipes to create something entirely new. So what unique water are you bringing to the reservoir?
A critical question for anyone building their career or their business in this space.
Thanks for joining us on this deep dive. We'll see you next time.
The future of artificial intelligence is unfolding, and it's happening at AI World Week, the flagship global event for innovation, collaboration, and transformation. This flagship global AI event is designed to connect visionary leaders, trailblazing entrepreneurs, and influential thinkers to explore the endless possibilities of AI. Experience groundbreaking technology that redefines industries and inspires progress. Join thought-provoking discussions on ethical AI, digital equity, and the transformative role of technology in our world. Build meaningful connections that catalyze innovation and drive impact. AI World Week is powered by AI World Society, a global movement dedicated to advancing AI responsibly and ensuring it serves humanity. Together, we're shaping a smarter, more inclusive, and equitable future. Continue your journey beyond the event with the AI World Journal, offering expert insights, in-depth analysis, and the latest trends shaping the AI landscape. This is your opportunity to lead, to innovate, and to transform the world with AI. AI World Week. We invite you to join us and embrace the AI revolution.